Most of us operate under the assumption that we are the masters of our own wallets, making logical choices based on data and calculated risks. But researchers have identified a persistent friction between how we think we decide and how our neurons actually fire, patterns of error that suggest our defaults aren't as rational as we believe. This is the core of behavioral finance, a field of study dedicated to mapping out the specific ways our internal mental wiring influences our economic behavior. By conducting a cognitive audit, we can isolate 4 specific psychological traps that lead to the same expensive mistakes across almost every demographic. Identifying these underlying neurological glitches is the first step towards building a defense for your capital. The first trap is loss aversion. The psychological math here is asymmetric. The emotional pain of losing $100 is measured as twice as severe as the joy of gaining that same amount. This disproportionate fear of pain causes many to hold on to failing investments long after they should have cut their losses, waiting for a recovery that the data says isn't coming. Conversely, it drives the urge to sell winning assets far too early, sacrificing long-term growth just to secure a small, immediate sense of safety. The second trap is herd mentality. When an asset's price spikes, the noise of the crowd often drowns out fundamental research. Driven by group chats and social proof, investors often assume the collective must know something they don't, leading them to buy based on popularity rather than value. But by the time a trend is obvious to the public herd, the institutional players have usually taken their profits and exited. The crowd often arrives just in time for the correction. Relying on emotional avoidance and social proof creates a scenario where an investor is prioritizing their feelings over their portfolio. Trap number 3 is anchoring bias. This is the brain's tendency to fixate on the very first number it sees, using it as a permanent baseline for everything that follows. If you buy a stock at $60 and it drops to 30, that $30 feels like a bargain, simply because you are comparing it to the $60 anchor, not its current actual value. The market is indifferent to your personal history. It prices assets based on today's conditions, not the number on your original receipt. The fourth trap, the sunk cost fallacy, is the most persistent. It occurs when you continue pouring money into a failing venture because of the resources you've already committed. The error is in trying to make past spending feel worth it. Instead of asking if you would invest more today, you throw good money after bad to avoid admitting the original loss. Treating unrecoverable spending as a variable in future decisions is a logic error that only accelerates financial ruin. These 4 patterns, the scale, the crowd, the anchor, and the shovel, provide a map of the most common ways our judgment fails us. These errors aren't a reflection of intelligence. They are a result of how human brains evolved to process risk and social standing long before the stock market existed. While we cannot rewrite our biology, naming these biases as they occur allows the analytical parts of the brain to intervene. Awareness creates the pause needed to double-check the math before a reactive choice becomes a permanent loss. If this audit highlighted a recent mistake in your own strategy, subscribe to join us for part 2, where we'll dive into more complex behavioral filters. Which of these 4 has been the hardest for you to override? Tell us your experience in the comments.